Hello, dear learners. I am Dr. Parul Jain from the Department of Economics, TAV PG College, Varanasi. Today, we'll be having the second lecture on money under the course Fundamentals of Economics and Financial Markets. In the last lecture, we have discussed what was the barter system that was going on, what were the difficulties which was faced by the wealth holders, how the money was evolved, the stages of evolution of money, the meaning of money, the important functions of money, and the qualities of a good money. Along with, we had an idea of the Gresham's law and high-powered money. Further dealing with the money, an important aspect that we'll be dealing today are the approaches to money supply. So, the topics today covered would include the approaches, which would include the conventional approach, the Chicago School approach, the Radcliffe Committee approach, Gurley and Shaw approach, as well as one of the most important approach in India is the Reserve Bank of India approach, that is the RBI approach. But before going to the approaches, let us all know what is the meaning of money supply. When we refer to the term money supply, what does that mean? Money supply means total stock of domestic means of payment that is held by the public. That means in the form of cash, in the form of credit, in the form of capital, any kind of wealth that is held by the people, the wealth holders, the households. Public, when we define, public means all categories of wealth holders, which would include the individuals, the households, the business firms, the state and the local bodies, except government, banks and RBI. We have to consider the stock held by the public in the disposable form only when we go for money supply, because that should be in circulation. However, with the banks, the government and the RBI is the administrative mechanism amount that is held by them. So that is not included in the money supply approach. So let's start with the first approach, that is the conventional approach to money supply. The conventional approach stresses on one of the important functions of money being the medium of exchange. The money supply, according to conventional approach, should include what? First, it should include the currency money. Currency money includes coins, paper notes in circulation that are held by central bank and the treasury. The 1 rupee note can be issued by the government. Rest all, the monopoly in the note issue is with the Central Bank of India, apex institution of India, banking institution. Along with the currency note, in the conventional approach, what constitute the money supply? The demand deposits. The demand deposits are the deposits that can be converted into cash whenever demanded for, like the savings bank current account. Whenever we demand for the money, we can go to the bank and take out that money and use. Therefore, it is a subject to check or the deposits in current account. We say that the backbone of any currency system is the central bank of a country, and RBI has the monopoly in note issue. However, the quantum of currency depends on the system of note issue. That means by what system we are supplying the currency in the economy. There are various systems. In India, we are using a minimum reserve system in which certain amount is reserved, a minimum amount that is kept by the central and the commercial banks, and rest is there for the public to be circulated, and the money supply part is formed from that rest amount. The central bank possesses the supply of money or notes. This depends on the system. According to RBI Act of 1934, the system that was reserved was not less than 40% of the total assets in the form of foreign currency and gold and bullions was held by the banks. This requirement, however, was changed in 1956, which provided this minimum reserve system of rupees 400 crores in foreign securities and 115 crores in gold coins and bullions. In 1957, this limit was further reduced to 200 crores. As I told earlier, in India, we follow the minimum reserve system. Along with this minimum reserve system, money supply also depends on the degree of monetization, how much money is there in the economy, as well as banking habits of the individual. If people have more banking habits, see, I have a check and I make payments in check to the other person, then there would be less of money supply, less of currency in the economy. We are transacting from one bank to another bank and doing our payments. So that would reduce the money supply. Second comes the Chicago approach. This approach was propounded and led by Milton Friedman, an economist. What does he state? He states that in modern times, time deposits are, to be simple and to understand, we can say FDs, that are fixed deposits that mature after a particular period of time. So, as I said, that can be withdrawn before maturity to convert that time deposit into cash, but that has two conditions. One, that the bank should honor your request to convert your FDs before a specific maturity date. And second, that the FD holder is ready to bear the loss of interest. The depositor willing to suffer the loss of interest and the bank is willing to honor. Nowadays, we see that the bank honor our request if we want to get our FDs, our time deposits converted into cash before the stipulated time. What we have to bear is the loss of interest. However, this approach was also beset with some difficulties. First and foremost, that time deposit was not a perfect substitute for currency or demand deposits. It could not do so. And second, time deposits cannot be used as a medium of exchange. See, I cannot give you my FD and buy something. I cannot say, see, this is my FD of 25,000 or this is my FD of 5 lakhs and give me certain amount of gold. I am giving you this FD. When it's get mature, you take the amount. So it won't serve as a medium of exchange. Another thing what we witness today is banks are giving the overdraft facility. If I am having a 5 lakh rupees or a 10 lakh rupee FD, the bank says, okay, fine, we are charging interest, but you can take an amount of 8 lakh rupees as overdraft. For this, the bank would charge interest from us, but the facility is there. So it was an approach that was beset with these few difficulties. To overcome this came the Ratcliffe Committee approach. The Ratcliffe Committee approach observed that there were various failures in the monetary policy. See, monetary policy is not always effective at all the times, and all the policy decisions are not appropriate also. So somehow Ratcliffe Committee found that at that time the approaches that were given by the monetary policy to control and to manage money supply were ineffective, and certain assets are also there in the economy which are close substitutes for money. Now, what were these assets? It was not only time deposits, demand deposits, but certain other assets were also treated as close substitute of money. That would include realizable assets or money that can be get from means of financing purchases. Realizable assets basically depend that those assets which can be sold off to get the cash in the form of, say, land, something. We have a land, we can sell that land and get a cash out of that, and that would enhance the money supply. Thus, in the Ratcliffe Committee approach, the money supply was determined and defined in terms of spendability, that is an important aspect, spendability what I am using, of the wealth holders, of the individual. This spendability is related to the amount of money people think they can get hold of. So, according to this committee, the legal tender money and the conventional money form only a part of the wider structure of liquidity. So, Ratcliffe Committee basically defined liquidity in a wider concept, and demand deposits, time deposits, currency were a part of this. They emphasized and gave a view in terms of general liquidity, which would include cash an individual has, all the bank deposits in terms of demand deposits, in terms of time deposits, deposits with other institutions, near money assets. Near money assets would include your treasury bills, your bill of exchange, your life insurance policies. These are all near money assets. Real assets, a property that we have, forms the part of an assets, as well as the borrowing facility available in that particular economy. Where the banks are ready to give you credit, there are NBFCs, non-banking financial institutions exist. So that would also enhance an individual spendability, how much an individual spends. But this approach also faced certain problems and was criticized on the heads like liquidity concept given under Ratcliffe approach was very vague and did not precisely define the liquidity. These all can be converted into liquid, but can these always be there as liquid? Further, Gurley found confusion everywhere in the role of money supply. To overcome these limitations of the approach came the Gurley and Shaw approach. Gurley and Shaw approach was inspired by early 1950s writing of Raymond Goldsmith. His work basically showed that all financial intermediaries grew rapidly during the first half of the 20th century. Although this was happening, the financial intermediaries were growing, but the claim of NBFCs, that is non-banking financial intermediaries, and the commercial bank was somehow declining. The commercial banks weakened the ability of central bank to control economic activities, and there was a need also to control the non-banking financial intermediaries. So somehow Gurley and Shaw observed that commercial banks, central banks and non-banking financial intermediaries were not able to control and manage this money supply up to the point. Further, they observed that progress of economic development in a large number of financial intermediaries emerged because these intermediaries were also serving as an institution for giving credit, for accepting deposits, for holding the primary securities. So people were finding these intermediaries as an alternative or as a place for commercial banks as well. So that the authors suggest, the Gurley and Shaw, what they suggest that money supply should be defined as weighted aggregate of currency. Now, weight should be assigned to different aspects of money supply, in which what they suggested was that weight of unity should be given to currency and demand deposits and zero weight for assets, which they are not related to components. But this approach also has given rise to a problem of making arbitrary decisions concerning of degree of moneyness. This approach also was not able to clarify that what should all get included in supply of money. Who is having a higher hold? Who is responsible for all these things? All the commercial banks were there. Central bank is the main authority that is giving the legal tender. The government was there. NBFCs were also coming out. So what constitute when we want money? Then came the most important approach, that is the RBI approach. See, the report of the second working group on money supply, it was published in the year 1977. It was in line with the first report that was published way back in 1961. The first group that gave his report on this money supply basically defined money supply in terms of sum of currency with the public and demand deposits with bank. It basically tried to merge and tell the total amount of currency that was held by the public in terms of currency, that included paper currency as well as the coin, and the demand deposits that were held by the banks in terms of savings bank current account. However, in first approach, time deposit was not a part of money supply. In lines with these, the second working group submitted its report and published it in 1977. What did this group said? According to, when we look into the report of this second group, it says that money supply is both an economic and policy controlled variable. That means in economy, the situation of the economy, the phase of the economy which we are going into, the type of economy which we are, like developed economy, developing economy, underdeveloped economy, and the type of government, capitalist, socialist, mixed, as in India, we are facing the economic cycle in which we are into, boom hai, recession hai, progression hai, what kind of cycle we are there, what are the behavior of macroeconomic indicators, what is the condition of national income that we are seeing, all include economic and policy variable, the type of policies that are going on in our economy, the monetary policy, the fiscal policy of the economy, the export-import policy of the economy, what kind of policy is dealing with, we are dealing with, that all controls the money supply. That was given by the second working group. Furthermore, the group observed that for monetary analysis, a single measure of money cannot be used. When we are talking of money supply, we cannot only talk in terms of currency or in terms of demand deposits. We need few more variables that define the supply of money. So, the second working group does not, however, suggest any basic change in the first group. But in their report, the second group introduced 4 important measures of money stock that were on the basis of varying degree of liquidity. Those 4 approaches include M1, M2, that is money 1, money 2, M3 and M4 approaches. Now, what does M1 consist of? According to the second working group, M1 was currency notes and coins with the public, excluding cash in hand of all banks. That means currency notes and coins with the public include that the money in circulation, that the people are willing to exchange, that the people are, that money that is giving people the purchasing power, the wealth holders are having this. That includes currency note and coins with the public. Along with this, M1 included demand deposits of all the cooperative and commercial banks. However, the demand deposits under M1 approach excluded interbank deposits. That means one bank and interaction with the other bank in terms of deposits that were excluded in M1, and any other deposits that would be held with RBI would constitute and consist the M1 approach, the M1 section, the M1 component of money supply. Then was the M2 approach. M2 consists of M1, that means currency and note coins with the public, demand deposits with all cooperative and commercial banks, that would definitely exclude interbank, and other deposits that are held with the RBI. Along with this, M2 introduced savings deposits with post office. in the form of small saving schemes, NSE certificates, any kind of saving deposits, the savings we do in post office, that would also be included in M2. M3 approach, as defined by the second working group, would include all the components of M1 along with the time deposits. In M1 and M2 approach, we were not including the time deposits. However, in M3 approach, all the time deposits with commercial banks and cooperative banks, same, excluding interbank deposits, but it was included, engrossed, envisaged in the concept of money supply. So now we are having currency, we are having demand deposits, we are having post office, we are having deposits with RBI as well as time deposits. This was the approach of M3. And the fourth that was given by second working group was M4. This would constitute M3 along with total deposits of post office savings organization, but excluding NSCs, because NSCs have a specific lock-in period. They cannot be so easily get converted into this. NSCs are having generally 5 years locking period. Before that, if you are converting, you have to bear a huge loss of interest. So NSCs were excluded. After the first and the second working group came the third working group, and it included few new aspects to this and redefined the approaches of money supply. The third working group, it was set up in the 1997 in the month of December. The chairman of this group was Y.V. Reddy. He was there to analyze the various analytical aspects of the monetary policy so that the monetary policy could be more effective. And it was a time, in economics we say the year 1991 has gone through a structural change, various kinds of reform, the economy opened up. So it was a phase from 91 to 97 when we are saying various changes, various reforms, various structural developments were taking place in the economy. We got the policy of liberalization, privatization and globalization, which we commonly use as LPG policy. These all were going on. New financial institutions were coming, financial sector was developing, digitalization was slowly creeping in the economy. So an economic scenario was changing with a certain pace. At that time, in this light of changing of the economic scenario, Y.V. Reddy was given an important and a difficult indeed task of analyzing these changes, these indicators, and then suggesting what could be given as the components of money supply. He submitted his report in 1998. What this third working group did was, they had a division of economy into 4 exclusive sectors. The first one was household sector. Household included us, who are the currency holders, who are the coin holders, who have demand deposits, who have time deposits, are households. Then was non-financial commercial sectors. Government sector was also there. The government which was dealing with all the fiscal policy was there. And the financial corporations were also included into this. The third working group amended the approach of money supply and gave the concept of M0, M1, M2 and M3. Now, what was this M0 approach? Why M4 was excluded? See, M0 was currency in circulation particularly. That is the coins and the currency notes that are there with the people whom they want to exchange. That is terms as currency in circulation, plus the bankers deposit, all the commercial banks deposits with the RBI, that is in the form of reserve ratio that RBI, on the guidelines of RBI, the commercial banks have to keep that certain amount with the RBI. Apart from that, it also included other deposits with the RBI. These all, like the currency with circulation, demand deposits with RBI and other deposits with RBI, the M0 was always compiled on the weekly basis so that the government and the RBI should know what is the scenario of the money supply. The M2 approach included the currency with public, demand deposits with banking system. Demand deposits are the demand liabilities portion of saving deposits. The compilation of M1 was fortnightly, that is every 15 days the compilation of M1 was conducted. M0 was every week and M1 was every 15 days. The M2 approach was further widened and the compilation period was fortnightly only. M2 included M1 plus time liabilities portion of savings bank deposits with the banking system. Basically, time liabilities portion of the saving bank includes the current account. Whenever current account or the FDs that we did with the banking system, that at a particular point of time, after a particular point of time, that amount would get matured and get transferred into account, and the term deposits of maturity up to 1 year with the banking system. That means all the term deposits that are with the banking system that have a maturity of not more than 1 year were included into M component of money supply as per the third working group. This was also compiled fortnightly. And the M3 approach. M3 approach would include M2, M1 plus other deposits and term deposits with contractual maturity of over 1 year with the banking system. Contractual maturity means when we are entering into a term deposit, there is a specific time period and an interest rate. If quarterly the interest rate changes also, then also if you have entered into a contractual maturity period, your term deposit will mature at that time with that specific rate of interest whenever you are doing with the banking system. So if the interest rate goes down, we will be in a beneficial position that our interest rate is contractually fixed and will be getting a specific rate of interest. So that was M3. That could be related to the contemporary time also, that nowadays money supply included not only currency with us, it also includes time deposits. It also includes term deposits that are contractually fixed at a specific rate of interest. The M0 is essentially serves as a monetary base because it is currency, bankers deposit with RBI and deposits with RBI that are others to bankers deposit. So M0 essentially serves as a monetary base. Therefore, this is also called as reserve money. And M0 is same as high powered money. What we discussed when we started doing the money supply. That is the high powered money that we can get and that serves as a base for RBI to decide various aspects of money supply. Therefore, we call it even high powered money. When we deal with these approaches of money supply, this M1, M2, M3, M4 or M0, M1, M2, M3, we should also keep in mind that money supply have certain determinants also, like the size of the monetary base. If you are increasing the size of the monetary base, your money supply, what would have? It would increase. People's choice regarding cash and credit portion. It is basically the people's habit of dealing with cash or with credit. If people are dealing more with cash, they are ready to circulate, they are ready to buy things with cash. See, even today, in the era of digitalization, still in India, we have a habit of dealing few aspects, especially the generations earlier to us have still a security, a habit of dealing in cash than in credit portion. They would immediately give cash for any kind of goods and services. So, if the choice of cash is more, the money supply the circulation of money in the economy would be more. If the credit portion is high, that means they are dealing on the credit basis, then the money supply would not be that high. If the cash reserves ratio in the form of SLR, cash CRR is the cash reserve ratio, it can be variable reserve, SLR with the commercial and the central bank. If the cash reserve ratio is high, then the money supply definitely would be low, because then banks have lesser amount to give as credit to the people to enhance the money supply. And same is the level of reserve with the bank. If the commercial banks are keeping more reserves with them, the percentage of reserves increases. What we talked of minimum reserve system. If the percentage of minimum reserve system is high with the commercial banks, then lesser amount would be there for creation of credit by the commercial banks. So these were the various approaches that we were dealing in money supply. It has a long journey from conventional to RBI approach. RBI approach, which is more contemporary, which is a very important approach that defines the components of supply of money in India and the determinants of money supply that would also have an impact on how much money is there for supply, how much money for supply, how much money is there with the people, how much money is there, and what is the velocity of circulation. So these were the approaches to money supply. When you have gone through these approaches, I think, and I am very sure, you will be able to answer this self-evaluation question that says, of explain briefly different approaches to money supply and how this RBI approach to money supply is different from other approaches. If you are able to get this answer written properly, then you have clearly understood the various approaches of money supply. The supply, it has gone, it has changed with the passage of time, and how the RBI approach has developed. And you should get other approaches, what all is included in the supply of money approach of RBI, which was lacking in other 4 approaches. So you should be in a condition and to answer this question. These are the suggested readings, which were same as the first lecture, that is Money, the Price Level and Interest by G.E. McKinnon, S.S. Misra's Money, Inflation and Economic Growth, and RBI report, that is the Chakravarti Committee report on the report of Committee to Review and the Working of Monetary System. So thank you, dear learners. I hope you will understand and find it convenient to learn through this what is money and the approaches of money supply. Thank you.